Hey everyone. So today we're going to dig into a question that sounds really simple at first, but is actually, well, a huge puzzle in finance. And that question is, when you invest in another country, what exactly are you buying? Is an amazing company in one part of the world the same as an amazing company somewhere else? Let's get into it.
I mean, really think about that. Let's say you find two companies. They've got the same business, same growth, same brilliant CEO, but one is based in Tokyo, the other in New York. Shouldn't they be worth the same amount? I mean, intuitively, you'd say, yeah, of course. But as you're about to see, the world of international finance has a very different answer.
You see, in a perfect world, this is what investing would look like. Just one big, borderless stock market. Money would just zip across the globe to the best companies, and it wouldn't matter if you were an investor in Paris looking at a stock in Sao Paulo. The logic would be exactly the same. It's a really clean, simple idea. But it's more of a dream than reality.
So here's our game plan. First, we're going to lay out what that perfect financial world would have to look like based on theory. Then we'll smash that theory with a dose of reality called currency risk. After that, we'll talk about these invisible walls that actually separate markets. And finally, we'll put all the pieces together to sketch out a much more realistic map for anyone investing globally today.
Okay, so let's start by imagining that ideal world. For this single global market to really work, a couple of big economic ideas would have to be true, kind of like the laws of physics for this financial utopia.
The first pillar here is something called purchasing power parity, or PPP for short. Basically, it's the idea that a cup of coffee that costs $2 in the US should cost the equivalent of $2 in Japan once you do the currency conversion. If PPP were always true, any differences in inflation between countries would just get canceled out by the exchange rate moving. A huge source of risk? Boof, gone.
The second pillar is called uncovered interest parity. This one says that if you see a higher interest rate in another country, the exchange rate is expected to move to wipe out that extra gain. So you can't just get a free lunch by buying some high-interest government bonds in another country because their currency is probably going to weaken and eat up your profits.
So you put all that together and you can see this perfect world needs some really, really strict rules. One interest rate for everybody. Zero currency risk because PPP works like a charm. No taxes, no fees to trade. And hey, we all buy the exact same stuff. It's a beautiful theory, right? But how does it actually stack up against the real world? And this brings us to our first massive reality check. That perfect, neat little model starts to fall apart the second you let in the wild, messy world of foreign currencies.
Yeah, the difference is pretty huge. The theory just pretends currency risk doesn't exist, but we all live in the real world, and it is messy. People in France don't buy the same stuff as people in Japan, so PPP doesn't really hold. And currencies? Well, they can swing like crazy. You could be a genius, pick the best stock in Japan, watch it jump 20%. But if the yen drops 20% against your dollar, guess what? You've made zero. Nothing.
You know, it's just like buying a cool souvenir when you're on a trip. The souvenir itself is awesome, but its value back home can totally change. And it has nothing to do with the item itself, just the exchange rate. It's the exact same idea for your international stocks.
And because this risk is so real, investors aren't going to take it on for free. They demand to be paid for it. And that's what we call the foreign currency risk premium. It's that little bit of extra return you need to see to make it worth your while to gamble on another country's currency instead of just playing it safe at home.
So what happens when a financial model breaks? Well, you build a better one. The old classic models just didn't work for global investing. So the experts came up with the International Capital Asset Pricing Model, the IAPM. It's basically an upgrade that says, okay, the return you should expect from a foreign stock depends on its market risk, plus its exposure to all these currency risks.
All right, so we've got a handle on currency risk. But that's only half the battle. There's this other giant factor that really shatters the dream of one big global market. And that's the fact that not all markets are open for business in the same way.
So here's a more formal definition of what we mean by market integration. To put it simply, it just means if two stocks move in perfect lockstep, when one goes up, the other goes up by the same amount, they should offer the same return. If they don't, it's a huge sign that there's some kind of barrier, some invisible wall stopping investors from just selling the pricey one and buying the cheap one.
And this really shows you the two extremes. In a totally integrated market, that dream world we talked about, a stock's price is set by global investors. But in what we call a segmented market, a country's stocks are priced mainly by local investors because it's just too hard for international money to get in and out.
And these walls, they're not just some abstract idea. They can be very real things, like a government putting up capital controls, or saying foreigners can only own 49% of a company. But they can also be more subtle, things like weird tax laws, or just a lack of good information, or even the fear that a new government might just take over the company. All of this stuff carves up the world into separate markets.
And hey, we can actually see this in the data. This isn't just theory. Take a look at India. For years, it was almost completely disconnected from the world market. But then in 1992, the government started opening things up for foreign investors. And look at that chart. The effect was immediate. It was like the walls started to come down in real time.
And it's not a one-off. You see the exact same story with Mexico. Before 1989, it was largely its own little island, financially speaking. Then, new policies came in, and boom, its connection to the world market shot way up. It just goes to show these walls are often man-made, and they can be taken down.
Now, just for some contrast, let's look at a country like Canada. The data shows it has been super integrated with the world market for a long, long time. Very few of those invisible walls. This kind of stability makes it a really good benchmark for what a truly open, integrated market actually looks like.
Okay, so where does all this leave us? We started with this really simple, elegant picture of one global market, and we've ended up in a place that's a lot more complicated, a lot messier. So let's try to pull this all together and draw a new, more accurate map.
So that's been our little journey, right? We started with a simple dream. Then we got hit with the first complication, currency risk. Then the second complication, those invisible walls. So the map we're left with isn't that simple globe we started with. It's more like a patchwork quilt of different markets, each with its own currency risk and its own level of openness.
And this, right here, is the big takeaway. A stock in Tokyo is not the same as an identical one in New York. To really understand its value, you have to factor in the risk of the yen bouncing around. And you have to understand just how open or closed the Japanese market is. It's a two-part puzzle you have to solve: currency and access.
Which leaves us with one last thing to think about. We saw with India and Mexico that markets are definitely getting more connected over time. So are we slowly building that perfect frictionless global market? Or will things like national politics and currency swings always make sure that perfect world remains just a fantasy? It's something to chew on. Thanks for joining me.